Hello, everyone. It's Professor Reiko here again, continuing on with our chapter on pensions. All right, so the first video we just kind of introduced defined contribution and defined benefit plans, and now we're going on to look at some of the issues in accounting for the defined benefit plans. So remember the last video I said really we spend all of our time on defined benefit plans, and that is where we are going to start now. So our two main issues, all right, that we deal with is what is the pension obligation, if any, and what is the pension expense? Just technically, it could be a pension asset or a liability. Usually, it's an obligation or liability. We'll talk about that in a second. And then, what is the pension expense that we're going to put on the income statement? All right. So first, we'll talk about the liability. How do we measure it? And then look at the funded status of the plan, and then we'll talk about the pension expense side of things. All right. So how do we measure the liability? All right. So your book walks through three different ways, three different methods. Right. In the past, these others that mattered, but when they changed the standard a few years back, the PBO became the one that really is what FASB requires companies to measure the liability as. All right. So let's look at this. So if you read through all of them, when you get down to this one, notice it says use all years of service at future salary levels. So all years of service will be the biggest number. And then future salary levels, typically people get paid more at the end of their, at the end of their career. So the future salary levels will be higher. So this results in essentially having the largest liability. So it's kind of, in a way, the most conservative one because it reports the largest liability. So that's the one we're going to use. You will see in some homework problems where they'll put the vested and accumulated obligations in the problem, but those numbers are irrelevant because all we focus on now is the PBO. Okay, so for the funding status of the plan, all right, the balance sheet must report the full funding status. All right, so it's simple to look at. We're going to compare the plan assets. So the fair value of the plan assets, that's the amount that's invested with the trustee. So we talked about in the first one how all the money goes to the trustee and is invested. That's what we're talking about there, the market or fair value of those assets. And then we compare that to our obligation. All right, so if the fair value, if all the assets are greater, that's a good thing, right? We have more invested than our obligation, so we're considered overfunded. And if the PBO is greater and less, we would have, so this would be called a pension asset because we have more invested than we do, than is our obligation. If the plan assets are less than our obligation, which is often the case, we are considered underfunded, and we'll call that a pension liability. So when we get to the worksheets in a minute, we'll have a column for the pension asset or liability. It can go back and forth, and we'll get to see that and when we start examples in our next video. All right, so that's on the balance sheet, and we'll use the worksheet on the next video to kind of come up with what the pension asset liability is. And then also we need to figure out what is the pension expense that's going to be on our income statement. All right, so there's 5 components of pension expense. All right, so we have service costs. So increase the PBO due to years to services rendered during the current year. Sorry, I couldn't get that out there. So if you think about in the previous video, we talked about how is the amount that we pay our employees determined. I said it's usually some sort of formula that's based on the number of years worked. All right, times some sort of average salary. And every company, like I said in the last video, will be a little different. Times some sort of factor to come up with the monthly amount. All right, so if service costs, if they work another year, which is what we're talking about here, so our employees have worked one more year, so this formula by default will increase, right? The product of that, if the number of years work goes up by 1, will increase. So they worked another year, therefore we owe them a little bit more, so that's going to be one component of pension expense for the period. The next one is the interest on the liability. All right, so interest accrues each year on the PBO because it's presented on a discounted basis. All right, so the actuary, remember we talked about in the previous video how we use actuaries and rely on actuaries a lot. All right, the actuary determines the settlement rate, which is the rate that we're going to use to calculate the interest cost. So see the formula here, it's PBO, and that should make a note, that's the PBO at the beginning of the period times the settlement rate will give us our interest cost. All right, so both of these will increase pension expense. All right, and you'll see what I mean here when we get to the worksheets in the next video. All right, actual return on plan assets. So let's think about the plan assets, remember, is the money that is at the trustee being invested. Okay, so that money is going to have some sort of return on it. This actual return is what we're talking about here. And this will be a number that's told to you by the trustee. The actual returns based on any interest and dividends, increases, changes in market value, whatnot. All right, this one, however, reduces current pension expense. And that's assuming it's a return. Now, you have really bad years every now and then where I guess you could technically have an actual loss on your plan assets. If so, then it would be opposite, but I don't think you'll see that in any of our examples. All right, our other two. So those first three you will see in every single problem, right? There's going to be service costs, there's going to be interest, and there's going to be some sort of return every single year. All right, amortization of prior service costs. All right, so on the previous page, we saw service costs. Now we have prior service costs. So what is this? All right, so prior service costs arises when a company amends their plan or they start a new plan to increase benefits for employee service provided in earlier years. All right, it says this amount is amortized over the remaining service years of the effective employees. All right, so that sounds like a lot. Let's just think about it. So let's say you guys have all worked for me for 5 years. And let's say today we start a pension plan. Okay, so that's great. You have this defined benefit plan that we're starting today. Well, prior service costs would be me going back and recognizing those prior 5 years. Because think about it, that formula, number of years worked. Well, if you've already worked for me for 5 years, you would want recognition for that. So that would be prior service costs. Okay, so let's say I amend the plan to recognize those 5 prior years that you guys had all worked for me. That would be prior service costs. Okay, and then what we'll do with that is amortize it, and that will be something that will affect pension expense. All right, so prior service costs, kind of two things. We have to amend the plan to create prior service costs, and then we start amortizing it over the remaining service years of the effective employees, and we start that in the year of where the prior service cost is created. Right, so that will also increase pension expense. We'll get to that when we start doing our worksheets on the next video. Right now, all we're doing is defining the 5 main components of pension expense. Our last component is our gains or losses. All right, so we have 2 different possible gains and losses. We have an asset gain or loss. Okay, so think about assets. So we talked about assets. That's the amount that's invested. All right, so notice it's the difference between the expected return from the actuary and the actual return from the trustee. Okay, so remember, we already recognize the actual return, and now we're going to talk about this expected return. Okay, and differences between those two we will recognize, and we'll talk about the reasons why when we get to that lesson, that video, which is a couple down the, towards the end of this chapter. And then we also can have what we call liability gains and losses. And this is a change in actuarial assumptions. So remember in the first video, we talked about the actuary is going to estimate how long people are going to work, what their salary is going to be, how long they're going to live after they retire, so we know how long we have to pay it. That's all going to be estimated. Well, let's assume they change some of their assumptions. That's going to change the PBO. Okay. Now notice it says it does not. This is listed under one of the 5 components of pension expense. But notice here it says does not affect pension expense in the current year. What it's going to do is it's going to affect the PBO, which will affect interest costs in future years, and then we may or may not have to amortize gains and losses. But we'll get to that once again when we get to that portion of the chapter. All right. So this talks about the asset side, asset liability side, the balance sheet side of things. Basically, we're over or underfunded, and then we walk through the 5 components of pension expense, meaning how are we going to determine what pension expense is that's going to go on our income statement. So what we're going to do in the next video is we're going to start with basically year 1 and go through and start using a pension worksheet to start coming up with what is the pension asset or liability and what is our pension expense. And you'll see how that all plays out. And then what we'll do in the videos after that is we'll just build on that and add more and more components. So we'll start with the first 3 components, our service costs, interest costs, and actual return. And then we'll add in prior service costs and the amortization of that prior service cost. And then we'll add in our gains and losses. And then we'll talk about if we have to amortize those. So that will be the next several videos. So it's kind of like one big problem that we just build on throughout each of the next videos. All right, so hopefully this is helping. We'll get rolling with numbers next time. at our next lesson. But we needed to kind of define everything first. So make sure you tune in next time as we start doing some worksheets, and that should be kind of help you start doing some homework and working through some problems come test time. All right, see you next time.